Hi, I'm Matt Rowland. I'm a shareholder at the law firm of Trenum Kemker. I practice in the area of business and corporate transactions. The focus of our tech talk is going to be how to raise money for your business without losing your assets or going to jail. I want to do this by examining some common myths when you're raising funds. I think one of the most common myths is that you can raise money from whomever you want. And frankly, and unfortunately, that's just not the case. While you can raise money from a wide spectrum of people, there are certain people that the securities laws favor. The securities laws are a body of law both at the federal level and at the state level, all 50 states, pretty complicated patchwork, that govern how you raise funds and from whom you raise funds. Really, the securities laws want you to raise funds from what we call accredited investors. Accredited investors are individuals with a net worth of $1 million or more, excluding a house, or individuals who make, on an average annual income, $200,000 individually or $300,000 with a spouse. Those individuals are deemed to be sophisticated enough, to some extent, to take care of themselves. So the amount of information that you have to deliver them, the amount of hand-holding that you need to do in the course of raising money from them, getting their money to fund your company, is substantially less. If you raise money from unaccredited investors, you have substantial information delivery requirements that are imposed upon your business in most situations. Those include audited financial statements, very lengthy descriptions of the business, and generally the sort of information that you would have to make public if you were trying to raise money for your company in an initial public offering. Hence, a very large burden on a small company. So in general, you want to limit your fundraising, if you can, to accredited investors. Another common misconception might be that you don't have to tell them everything. As long as you answer questions truthfully about your business, you're not subject to liability. Again, that's not the case. You are required, whether it's an accredited investor or an unaccredited investor, to disclose all material information that a reasonable investor would want to know. And that includes not just answering questions truthfully, but telling those individuals about your business, things that you know that that individual may not know, as well as things about your industry and your competitors that may not be subject to common knowledge. If you don't tell your investor all material information that he or she may want to know, not only could that investor come back and sue your company if things don't turn out in the future as you would like to see, but that investor could come against you personally. This is one of those rare exceptions in corporate law or in LLC law where an investor or a third-party creditor of the company can actually come against you personally as a promoter. So you need to be very careful to tell them the truth, the whole truth, and nothing but the truth. Another common misconception is that your company will be judged solely on the strength of your idea. Now, you may have a great idea. It may be the perfect solution for a widespread problem. That doesn't necessarily mean that individuals are going to want to invest if your company doesn't have its house in order. It's very important that you have both your legal and your accounting documents in order. You will be judged not just on the personality or the brains of your company, but also on how good it looks to a potential investor. A final misconception that we'll address briefly here this morning is that crowdfunding is going to be your salvation. You might not like what you just heard about raising money from accredited investors, unaccredited investors, and you think, well, I've heard of this thing called crowdfunding, which was approved by the Jobs Act that President Obama signed in early April. This is still the Wild West of fundraising. The SEC still has to put into place regulations that are going to govern how crowdfunding works. But the few things are known. One, you're limited to $1 million a year, but that has to be done through authorized portals or broker-dealers. They're going to take a commission, and you could end up with a lot of fundraisers, a lot of small fundraisers who may be calling you on the phone 6 months, 8 months down the road, wondering where their money is, how the company is doing, and it may be more of a hassle than you bargained for. So I think we need to wait and see how crowdfunding turns out. But for the meantime, I think if you stick with a few basic rules, namely, tell the truth, and if possible, stick with accredited investors, you'll be just fine. Good luck in your business.